Hello, friends. Welcome to Unshakeable, your Financial Freedom Playbook. I'm Anita Verma, from StoryNest VideoBooks. I'm business director, consultant, author, and an unapologetic lover of books. After years helping brands shape their stories and strategies, I've learned one truth that never fails. Clarity creates confidence. In this journey, we'll bring money matters down to earth. Simple, practical, and empowering. So every chapter feels like a conversation with a trusted guide. Take a breath. If you've ever felt stuck on one paycheck, anxious about bills, or unsure how to start investing, you're in good company. Financial freedom isn't reserved for the privileged. It's a path you can walk, one steady step at a time. This playbook distills field-tested principles inspired by world-class investors and clear everyday actions you can actually do, whether you're a student, salaried professional, small business owner, or the rock of your family. This script is your invitation to move from earner to investor. Ready? Let's turn knowledge into calm, confidence, and long-term wealth. Here is lesson number 1. What it really means to be unshakable. Narrator's cue. Imagine standing on solid ground. Markets swing, headlines scream, yet you remain steady. To be unshakable is first a mindset, then a money plan. It means you trust, deep down, that you and your family will be okay, through booms, busts, and everything in between. You may feel fear for a moment, but you return to center quickly. Others may panic. You choose poise. Leaders think this way. So can you. How do we get there? By focusing on what you can control: your savings rate, your asset mix, your investing habits, and your emotions. The goal isn't to predict markets. It's to build a system that works regardless of what markets do. The simple engine, compounding narrator's cue. Picture a snowball rolling downhill, gathering more snow with every turn. Compounding turns small, consistent contributions into meaningful wealth. Start with a slice of your income each month and automate it into broad, low-cost index funds. Let time do the heavy lifting. Consider 2 friends investing 25,000 rupees per month at a 10% annual return. Early starter invests for 8 years, then stops, but leaves the money to grow. Late starter waits 8 years, then invests the same amount every month for 39 years. Despite investing for a far shorter time, the early starter can finish richer, because time in the market beats timing the market. That's compounding's quiet magic. Action cue. Start now. Automate monthly. Avoid interrupting compounding unless it's a true emergency. Here is lesson number 2, the wolves versus the tortoise, active funds versus index funds. Many people choose mutual funds to play it safe. The problem? Most actively managed funds try to beat the market by trading often, and the price you pay is buried in fees, taxes, and human error. Frequent buying and selling racks up costs. Managers must be right twice, when to buy and when to sell. Even pros struggle to do this consistently. And when gains occur, short-term trading can trigger higher taxes. Now meet the tortoise, index funds. They simply buy the entire market, say, the Nifty 50 or the S&P 500, and hold. Fewer trades mean lower costs and fewer tax headaches. You're instantly diversified across leading companies without guessing who wins next quarter. Legendary investors have long favored this approach for most people. Keep costs low, keep taxes low, stay broadly diversified, and stay invested. Over long stretches, markets tend to reward patience more reliably than prediction. Action cue. Make a low-cost, broad market index fund the core of your portfolio. Add selectively only if you truly understand the risks. Here is lesson number 3, the core 4. Principles the best investors live by. Across interviews with world-class investors, 4 timeless rules keep repeating. Think of these as your investing compass. 1. First, don't lose big recovery from deep losses is hard. A 50% drop needs a 100% gain just to break even. Protect the downside with a plan. Diversify, set the right asset mix, and avoid bets that can sink your progress. 2. Seek asymmetric outcomes. Look for situations where potential upside clearly outweighs downside. That could be buying quality assets at depressed prices or steadily investing during pessimistic periods. You don't need to swing at every pitch. Wait for favorable odds. 3. Be tax smart. It's not what you make, it's what you keep. Favor longer holding periods to benefit from lower long-term capital gains rates, where applicable. Prefer low turnover, low-cost funds. Place tax-inefficient assets in more tax-advantaged accounts when possible. 4. Diversify, then diversify again. Spread across asset classes, stocks, bonds, real estate, commodities. Within each class, many companies, not one, favorite. Across regions, currencies, and over time, keep contributing regularly. Diversification is shock absorption for your wealth. Narrator's cue. Over a lost decade for one index, a diversified mix still compounded respectably. That's the quiet power of many uncorrelated engines pulling your portfolio forward. Here is lesson number 4. Slay the bear. Turning downturns into opportunity. Narrator's cue. When markets fall and fear is loud, disciplined investors lean into their plan. A bear market, a prolonged decline, feels brutal in the moment. But historically, every bear is eventually followed by a bull market. Prices go on sale, yields improve, and future returns often rise from those lower levels. Here's how resilient investors prepare. 1. Anchor in index funds. Make broad, low-fee index funds your foundation. They're diversified, efficient, and hard to outpace after costs and taxes. 2. Add income streams, include bonds, dividend-paying stocks, and REITs, real estate investment trusts. When markets wobble, these can provide cash flow so you're not forced to sell at the worst time. 3rd, rebalance annually. If stocks fall and bonds rise, you may drift from, say, 60-40 to 45-55. Rebalancing nudges you back, selling some of what held up and buying what's now cheaper. It's a built-in buy low, sell high habit. 4. Keep your nerve. Headlines are designed to stir emotion. Your plan is designed to protect you from it. Breathe, stick to your rules, and let time and compounding do their work. The final summary: calm, clarity, and compound interest. You now hold the essentials. Start early, automate, and let compounding work. Keep costs and taxes low. Live by the core 4. Don't lose big, seek favorable odds, be tax smart, and diversify widely. Welcome volatility with a plan. Anchor in index funds, add income, rebalance, and stay calm. Wealth isn't a sprint, it's a steady walk. With each disciplined step, you become more unshakable, not because markets stop moving, but because you do not. And when abundance arrives, consider how you'll share it. Many of the greats choose generosity as their final investment, one that compounds far beyond numbers. Thank you for listening. This brings us to the end of the video book. I'm Anita Verma, and it's been my privilege to bring these words to life for you. May the insights and stories you've heard continue to guide and inspire your journey ahead. Please don't forget to like, share, and subscribe to my channel, StoryNest VideoBooks, so you never miss our upcoming video books. Until next time, stay inspired and keep listening.